An initial public offering, IPO, is what, exactly? An initial public offering, IPO, is the procedure of releasing fresh shares of stock to the public for the first time in a private firm. A corporation can raise equity funding from the general public through an IPO. Since there is often a share premium for present private investors, the transition from a private to a public firm can be a crucial period for private investors to completely realize rewards from their investment. Additionally, it enables public investors to take part in the sale. The process of an initial public offering, IPO. An organization is regarded as private before an IPO. The company has expanded with a relatively small number of shareholders as a pre-IPO private company, including early investors like the founders, family, and friends, as well as qualified investors like venture capitalists or angel investors. A company taking part in an IPO is taking a big step because it opens up the possibility of significant capital raising. This increases the company's capacity for development and growth. Additionally, the increased transparency and credibility of the share listing may help it get better terms when looking for borrowed money. This stage of development often starts when a business achieves unicorn status, or a private valuation of about $1 billion. However, depending on the market competition and their capacity to meet listing standards, private companies at varying values with sound fundamentals and demonstrated profitability potential may also be eligible for an IPO. A company's IPO shares are valued via underwriting due diligence. When a company goes public, the privately held shares are converted to publicly held shares, and the shares of the existing private shareholders are now worth the public trading price. Special terms for private to public share ownership may also be included in the share underwriting. Millions of investors have the enormous possibility to purchase firm shares and add money to the shareholders' equity of a company through the public market. Any person or institution interested in making an investment in the company is considered a member of the public. Overall, the components that create the firm's new shareholders' equity value are the number of shares the company sells and the price at which shares sell. When a company is both private and public, shareholders' equity still refers to the shares that investors own, but when a company becomes public, the cash from the main issuance dramatically raises shareholders' equity.